Thank you all for joining today's webinar. So, when we look at the topic rising above inflation, how to make your money work harder, this topic is not just a timely one, it's a timeless topic. As you all know, inflation, which is part of our everyday's life, right? So, today we're going to look at why it's so crucial to beat inflation and how to ensure your investment don't just grow, right? But growing in the sense like, kind of after accounting inflation, how it has grown. That's what we need to. So this is something lowest in many years as a welcome relief for most of the consumers, no doubt in that. But RBI has also projected that the inflation to be an average around 3.7% for the financial year FY26. So while this dip is good, we should be more cautious, not more kind of complacent yet, right? So now here's a twist. If your money is sitting in a savings account, like just say where the kind of you do a lot of UPI payments or a lot of transactions and so that what happens, the money will go in and out, right? So around you'll be getting around 2.5% as saying if you keep your money in that account. Or else let's take FD. So the earnings will be around 5%. I mean after tax. So you're barely staying ahead of inflation or making not just all if it's all inflation rises again. That's what. So inflation is not just about higher prices, it's about what your money can't buy anymore. Here's a simple rule to remember. If inflation is greater than saving, the real wealth will be getting eroded. So let's say you are saving like 1 lakh today, like let's take example, and inflation is around 6%. In 10 years, your money buying power will shrink significantly unless it's growing faster than what inflation is growing. So inflation is something like an invisible but very powerful one. You don't feel it daily, but look back 5 to 10 years back and compare petrol price, even the grocery vegetable price, rent, even your kids' school fees. It hits you hard. So yes, so when we see like for example, when the central bank raises interest rates to fight inflation, your loan EMI goes up. But does your FD returns go up? No, obviously no, it's not going to go. Yeah, thanks for the confirmation, guys. So that's what I mean, like higher rates cool the economy, which impacts corporate profit and your equity investments too. So inflation is not just a number, it shapes how you spend, save, and invest. So saving alone won't do it. Parking money in some low interest product won't beat it. The solution lies in how you build an investment portfolio that grows above inflation, not in line with or something below that. So remember, inflation may look small today at 2.1%, but over time it compounds like kind of a silent tax. So the goal is not just to grow your money, it's to grow in a real terms after beating inflation, right? So now that we seen how inflation quietly eats away your purchasing power, the next question is right now, what do we do to get away from this? The answer is simple in theory, but hard in practice. You must make your money grow faster than inflation. It looks something kind of a simple stuff, but that's the only way kind of your saving not only preserve value, but create wealth over time. So now again, let's kind of see some calculation. If inflation at 5% a year and your investment earns just 4%, you're actually losing your purchasing power. So we must target return that outpace inflation consistently. That's very much important. That typically making something kind of a return around 8 to 12% or more, depending on how your financial goals and timeliness you manage that. That's important, right? And where you can aim for these returns. Certainly, it's not going to come from your short-term FTs or from your saving account. Something kind of intelligent investing is required to beat the inflation. Something like asset mix and something more we should go through. So right now, I'll just go through something in a short, but in the later slides, I'll go through in a deeper manner to this. So first, as everyone knows, it's equity investment. So equity has been best performing asset class over the long term. Yes, it's volatile, but volatility is not risk if you have time on your side. So over the last 15 to 20 years, the Nifty 50 has returned around 11 to 13% CAGR, even through crashes, elections, pandemics, and more. The next is systematic investment plan. SIPs help you to invest consistently no matter what the market is doing. They remove emotion and market timing, and from your decisions, you buy more when prices are low and less when the prices are high. So this is called rupee cost averaging. It plays. We can go deeper into SIPs in the later slide. Same way, the asset allocation, diversifying across equity, debt, gold, even foreign equities help to balance your risk. So um, I'll just take the questions after this webinar. Okay. So, for example, see, like equity may perform well in a growing economy, but gold can protect you during the crisis or inflation spikes. So, having a good asset allocations is really important in this current scenario. So, a well allocated portfolio ensures all weather performance, not just in the bull market, what you're kind of seeing in the last 2 to 3 kind of last year, you can say, right? So then, of course, the Nifty 50, it's India's benchmark stuff. You can see it has given around 12% CAGR over 20 years. So if you have invested like 1 lakh in Nifty 50 in 2004, it would have been worth around 9.5 to 10 lakhs. So without any kind of timing or trading, just you've been there. That's the thing. Uh, okay, I think I'll just wait. I think it's visible. I think so, right? You can just confirm. Okay, fine. So yeah, so when you take emulation like around average like 5 to 6% in real time, you made some good money only by investing in Nifty 50, not doing any trading and so. So the yeah, right now I'll just like to go through the SIPs. So now that we have seen how equity and long-term investing can beat inflation. So let's talk about one of the most powerful tool available in everyday's investors' life, that is systematic investment plan. SIPs are not just a convenience tool, they are a wealth creation engine when used it rightfully. Let me show you why they are called SIPs work on two simple but most powerful concepts. As I stated earlier, rupee cost averaging. You buy more units when the prices are low and fewer when the prices are high. And over time, this evens out your purchasing cost and removes the emotion burden that of market timing and so. The next powerful thing is called the compounding, the power of compounding. Regular monthly contribution grow exponentially with time. Then the longer you stay invested, the more your money works for you. Think of it like planting a seed every month, not just one tree, but a forest, right? And over time, the forest begins to grow and multiply massively, powerfully, and very good, right? So let's take a look into this simple calculation. Suppose you invested 5,000 every month through your SIP in an equity mutual fund, right? Any fund, you just assume it's giving a kind of a 12% return per annum, by which in line with the long-term Nifty or diversified equity fund return. Okay. Okay, over 10 years, you would have invested around 6 lakhs in total. So just see, but your corpus would have grown like around 11.6, around 12 lakhs, right? So nearly double your investment income. So that's what how the compounding works. So it sounds great, right? So we are okay. Let's see. We are just adjusting a kind of a 5% inflation, which is the average inflation in India over the past decades, right? After inflation, your value around 12 lakhs would come around 7 lakhs in real terms. This is what matters, real purchasing power. You still gain because your money has grown faster than inflation, and that's the real win. Let's in contrast, let's see, you are invested in like a hold habit. You just put your money in some recurring deposit or a saving account. Best case, you would have made something around 5 to 6% return. With inflation, also same like around 5%. You barely reach the break even or the kind of the same point you have reached, nothing more or less you made, right? So no money you are just generated, just your money got eroded. That's the thing. So SIP on the other hand makes your money work harder, adapt to market cycles and compound with time, as I stated earlier. So Most importantly, it's discipline, nothing else. So you invest regularly no matter what the market or headlines are saying. Some people think that SIPs are the only for beginners or a small ticket investor. That's not at all true. High income investors use SIPs to automate their equity exposure. Even I saw many HNIs even use STPs, like systematic transfer plan from debt to equity for advanced compounding strategies. So SIP has been used for every kind of people. There is no like only small investors go for SIP, not like that. So SIP is just not a product, it's a mindset of patience, process, and participation. Okay, before we talk about growth and return, let's take a step back and see because you can't build wealth unless you protect your foundation first, right? And the foundation is something called emergency fund. Your first line of defense is financial planning. Think of it like a seatbelt, right? You don't drive expecting an accident, but you still wear one, right? So similarly, we don't plan for emergencies, but we must be ready for something like that. So before investing, secure your base. Many people jump into SIPs, equity funds, or some tax saving options and all. Even see they kind of save like around 50,000, even in a kind of a tough situation. But the result, when the life throws a curveball, like something like job loss or something like health issue or kind of something happen, you just think which should not be taken place, they are forced to withdraw from their investment prematurely and enter into compounding cycle break. So as we saw, most of our clients within a year they are just taking out their money, just one reason, personal reason. So yeah, so it's very important to have an emergency fund which protect your long-term goal from the short-term shocks. So how much should you save? So this is a simple rule. See, like 3 to 6 months worth of monthly expenses. So this can be something your rent, any EMI bills, or something. Let's take example like all your grocery and some kind of small expenses what you used to go through your daily days, around 50,000 a month. So just make it into three or into six. So it's coming around like 1.5 to 3 lakhs as your emergency fund. This is not your money you invest to grow, but it's money you keep to feel secure. Okay. Uh, so this brings us to the point where the an emergency fund is something like protect you from making desperate financial decision. Imagine the scenario like you may lose job tomorrow or you meet sudden medical expenses. Even your insurance cover also is not sufficient to kind of handle that. Or if you're a business people, suddenly a business drop, so something could happen. So without an emergency fund, it's like your long-term SIP you're getting broken, and you'll lose compounding obviously. Then you'll sell equity at the downturn market where you feel that if not be sold. So even some people will go for higher interest credit cards or personal loans. So it's for safety in a place, just go with some emergency fund. That's the thing. So now we are just covered the most important topic, emergency fund. So let's move to the real engine of wealth creation, that is asset allocation strategy. The number one rule of investing isn't chasing return, it's managing risk and beating inflation consistently. The only way to do is through diversification. That's what this slide is all about. So think of asset allocation like a building a cricket team. You can't win with just batsmen. You need bowlers, all-rounders, fielders, keeper, and so. Similarly, your portfolio needs a balanced mix of asset classes, each playing a different role, like offensive, defensive, kind of stability, and so. We broadly divide this into something like a four main assets, like so first is obviously domestic equity. So investing in equity funds in India, this is a growth engine. Over long period, equity has consistently beaten inflation. The Nifty 50, as we saw earlier, has given around 12% CAGR over 20 years. So ideal for 5 years or more kind of goal tenure. For wealth creation, retirement, or a child education, as a Indian equities is a good stuff. So equity SIPs also offer a kind of a good rupee cost averaging, help to manage volatility. So the next thing is gold, so which plays a different role. See, it preserves value during uncertainty. So when you see when gold historically, when you see gold's performance during this inflation spikes, even market crashes like global crisis like COVID, it was something like most of the investors used to put money there as a kind of a safe haven. Yeah, so the next asset class is fixed income. So this is a safety net for a portfolio, but debt instruments like corporate bond, government securities, they give a predictable income and a capital protection, especially useful if you're choosing to have a financial goal or have a low risk appetite. In equity, equity is more volatile, where debt brings you peace of mind. And in this current scenario of more consolidated market, in debt will be a more preferable one. Then foreign equity, often overlooked, but increasingly kind of an important one, I would say, because most people right now just having a good idea of this foreign equity and stuff through global funds and so. Not only investing in India, so having a geographical diversification is also kind of a good way to diversify your portfolio and to have a good risk appetite return. And they give you access to some sectors that not prominent in India, like for example AIs, semiconductors, even more R&D related works where India is still behind. We have some other countries where they have some good exposure over there. So over the long term, foreign equities also help to protect against rupee depreciation. Ideal exposure like around 5 to no, like some kind of a little exposure compared to other asset classes would be preferable based on your current goals and your period of holding. Everything plays a good matter. So, so how we know how to build this asset allocation? So it's very simple. It's built on something called your goal, your time horizon, your risk appetite. So based on this, the risk and asset allocation will be made by us. And so I would like to discuss some mistakes what people used to go through, like going all in on equity, ignoring debt. So I think this is most common mistake we can find. Most other people will go, they'll go fully into equity, they'll just ignore debt. So that's not a good thing, I would say. Then treating gold as a primary investment. Not only gold, there are some other precious metals also there. They are having a good long-term kind of growth and so having a good exposure to them also is really a good thing, and not reviewing their asset allocation yearly. As you grow older, your goals also get older. Your asset allocation should shift gradually from aggressive to conservative. So taking this everything to your own care is also very important. Okay, now that we build a well-diversified portfolio, let's talk about what most investors forget. That is reviewing and rebalancing. Imagine you're driving from Chennai to Ooty. You don't just fix the steering wheel in one direction and hope you reach. See, you keep checking the road, adjust the speed and steering as needed. Similarly, your portfolio needs to be a regular review to ensure it's aligned with your financial goals. We recommend doing this like around 6 months once, or like if you can't, like you're very busy like that, then just at least in a year you should kind of review your portfolio at least once. That's very much important. Things like job shift, like family needs or a market search can disturb your original asset allocation. And if you don't fix it, you drift off, of course, right? So rebalancing is a process of bringing your portfolio back to your target mix. So something, when you start your investment, you have something in your mind. Later on, this market movement would change the asset allocation. So you should know how to kind of rebalance them on a timely basis, or else your goal would not be reached as what is targeted. So sometimes like you do rebalancing, like some booking some profit or reinvesting some lagging thing like from uh, thing like gold or debt and so this is how kind of make some good investment without timing the market. So over a long run, rebalancing can have a good kind of emotional impact, like reduce your volatility, improve risk adjusted return, and keep your behavior disciplined, which is kind of the half the battle in investing. So how do you can actually do this? Use a kind of a calendar approach. If you feel like rebalance every January 1st or like every 6 months once, if you are not feeling kind of following any financial year and so, or use some threshold approach. Like if you feel that your asset class has moved significantly, just based on your mindset, you can just make the change. But it's very much important to have a proper review and rebalance. So the key idea behind this is don't let the winners run like unchecked. See, don't ignore the underperformers. That's very much important. Okay, let me ask you something. Why do you invest? Is just to grow your money, or is it to buy a home, or to give your kids the best education, or to retire comfortably? So, or maybe start the dream business. So, having something in your mind, that's what the goal-based investing is all about. It means we invest not just for returns, but for a purpose. When you start with a why, your money gets direction, and with the direction, it gets more discipline. Most of the mistake investors make, like something like because of the emotions like fear, greed, impatience, they used to make a lot of mistakes, right? But when you are investing for a specific okay, you don't just get panic because the market fell last month. See, the goal-based investing helps in three ways. It aligns your investment with the kind of a real matters, like something like you're connected more, like home, education, or retirement. It reduces the kind of more harshy and kind of more sudden decisions what you used to make and emotional reactions, and so it increases the chance you'll actually stay invested, and that leads to a better outcome. One of the biggest myth in investing is that more return equal more success. That's really not true. Without purpose, how much return you make, that's not going to give you any good thing. So what people truly want is a yeah, of course, a good peace of mind when they're in this investment journey. They want to know they are on track. They want so see, when you have some clear goal, you just don't get obsessed on market movement or you won't compare with your peers and so. Instead, you ask, am I on the right track to reach my goal? That's the real peace, that's a real control. So here's the takeaway. Don't chase return in isolation. Anchor your investment to your life goals. Let your SIPs, your asset allocation, your strategy all point towards something meaningful. Because in the end, we invest not just for money but for a life of dignity, freedom, fulfillment, something we want to achieve that thing. So this is the power of the goal-based investing. So now let's bring everything we discussed so far, goal-based investing, that asset allocation, review, rebalancing into a practical framework. So let me introduce you to our flagship offering that is Milestones to Wealth. So this is not just a product, it's a guided journey, by the way. A journey where we help investors like you grow from 5 lakh to 1 crore in a planned, systematic way. Whether you are just starting out or already in your way, M2W gives you a clear path, steady momentum, and expert support along with the good momentum, by the way. So how does M2W work? See, it starts with you, your goal, your starting point, your time frame. Suppose you say, I want to reach 1 crore in 10 years, or I have 5 lakhs, no, plus some 20,000 a month I can invest. We sit with you, then map the journey using, we have good proprietary frameworks. Based on that, we make proper asset allocation for you and market tested strategies. But it doesn't stop that. We don't just create a plan and leave you on your own. Every 6 months or even like every time when you ask something, we just review your process from time to time. Even if market is overrated, we may recommend booking partial profit or like shifting to different asset classes from gold, debt, and all the stuff should be taken care by us. This is a kind of a hand holding is what's said to be MW part. Now, what you might wonder right now is that why do you invest in under M2W? See, the foundation of M2W is something, this mutual fund distribution model. So something people used to say, why mutual fund? See, because they offer diversification, liquidity, and good professional management. They allow us to build a kind of different asset buckets like Indian equities, foreign equities, debt, gold, everything can go through mutual fund route itself. And most importantly, we can scale and adjust without any hassles, right? Everything's structured, regulated, and trackable, by the way. And through mutual funds, we can align your portfolio with your proper risk profile, whether you're conservative, balanced, or aggressive. So there are many SIP calculators, but there are kind of more robo advisors and apps too. But here's what the M2W is different. We are more personalized, periodic reviews, human guidance when market test your patience. We are not here to chase the returns, right? We are here to make you to reach your milestones without any stress, confusion, or kind of without any delay. Whether it's buying your first home, building a college fund, or a retirement kind of stuff. We help each clients based on the strategies and based on the different goals to have a better prosperity lives for you. So if you are wondering how to turn your money into a meaningful journey, not just wealth for wealth's sake, but wealth for purpose, then M2W is built for you. We invite you to start your own milestones to wealth journey with us. So one step at this with the right mix of guidance, views, and confidence. Because see, earlier you start, the sooner you arrive, and we'll love to talk with you and move every step with you. So yes, finally, I would like to summarize the whole webinar. So don't let allow your inflation to eat your savings. So have a proper asset allocation, have a good SIPs, make good return. So you can contact M2W. We guide you through all the prospects of your life. So thank you guys for attending this webinar.